Hello and welcome to this panel on private finance on public chains. My name is Tim Copeland. I'm head of growth at The Block, crypto media site. We have a stacked panel today, so I'm going to give each panelist 30 seconds to introduce yourselves.
Hey, I'm Danny Bailey from Blockdaemon. We are the leading infrastructure provider within this space, bringing Web 2 into Web 3 since 2017 and have launched over 250,000 nodes within this space and run an MPC technology that Tier 1 banks use.
Hi, my name is Sanjeev. I'm the co-founder of Zonex. We are a Silicon Valley-based company in real-world asset tokenization. We build a platform for institutions to come on chain. And we actually built something unique. It's a compliance inbuilt, embedded on a token level. And the jurisdictions, it's actually regulations embedded on the governance of the token as well. So yeah, this is our 8th year in this space, and proud to be with Midnight to programmable privacy to actually put it on RWA's real-world asset tokenization.
Hi, I'm the founder of Midnight.network. We do zero-knowledge permissioning. Think log in with Google, but we can get any information from any website and prove it to another website.
All right, so first question. How can we design permissionless systems that still preserve meaningful financial privacy?
So my experience dealing with institutions over the years, especially with the banks. In US, it's more to do with the Genius Act when it's just getting passed. And I believe the financial institutions require more programmable privacy and the regulations and compliance. And that's the first thing for them to actually be on chain. And the more, what I see is the adoption would actually go more with, the private chains. But now, since we have a programmable privacy on embedded, and the regulation and compliance is embedded on a token level, actually, that's more of the preference for financial institutions to adopt, digital assets ecosystem.
Yeah, I think if you look at institutions, having come from one of the world's largest Tier 1 banks, they're not going to want everything to be available to everyone in terms of the information, how they're transacting, who they're transacting with. It doesn't mean to say that you're trying to hide any of that. What you're actually trying to do is allow the right people to know the right information to allow that transaction to go through in a correct, auditable, and compliance way. I always think about, if you look at most organizations, they'll have SOC certifications, they'll have ISO certifications. You don't necessarily go through that process with every individual. And if you look at something that Midnight's trying to achieve here, is the ability to prove something without showing all of the information to everyone. So the fact that you may have a certification that allows you to work in a certain manner, that's almost what we're trying to do in a very different way in a financial system to prove that we can transact, we should transact, but with the right information for the right people.
I think it's what's really interesting is when you look at how this has developed in the last sort of 20 years with privacy and PII and data sharing. I think what's shifted is kind of the rational element of what is rational to share. In the past, it wasn't rational to send your passport to a random startup on the internet. It wasn't rational to send your driving license or your proof of address to a random person you didn't know, and let alone rational to do that about 5 times a year, as the previous Director General of MI5 apparently says that he gives his information around the internet to these random startups as well. And I think that's where it's really interesting with the whole idea of rational privacy with Midnight and bringing that back into, okay, well, this actually makes no sense, and doing things like what we're doing with keyring to use zero knowledge to prove only the things that are relevant instead of just showing everything and pulling your trousers down for effectively everybody in these individual startups.
Okay, and are there any technical components that are still missing to unlock privacy on public chains?
I think we're getting there. If we look again at, I think Farmi mentioned it, and it was mentioned earlier this morning, around the evolution of the blockchains. of where we're at the moment, and we're looking at 4th generation in terms of what you decide you want to disclose versus what should be available. I think if we think about the institutional adoption side of it, this is moving faster than what they are. So I think it's more about them starting to understand how they apply this rather than are there missing components. It's about how do they get internal decision makers to come on board with what's appropriate for them and their organization rather than there being missing components. I do think the ability to build on Midnight is giving the optionality of what you want to disclose, why you want to disclose it. If you think about any transaction, whether you're working in a small startup, whether it be an SME enterprise kind of business, all the way up to a bank, you don't want all of your information and your transactions available to your competitors. Right? You don't want them to know what is there. And it's not because you're trying to hide it, but that is just the nature of any business. I do think the larger institutions now are starting to get on board with what they can do with blockchain. And I think this 4th generation is something that they're really going to need to catch up on to start leading the way with what they can provide their end customers.
I think interoperability actually makes compliance, interoperability, and accountability for regulators. If we see the institutions are more to get an exposure of all these three to be on chain. But if you see most of these experiences from the asset managers, fund managers, or probably institutions with whom we are talking, they would want to see more interoperability on different chains and regulations and compliance inbuilt in it. So I believe that's one of the things which we see has been moving pretty fast on the adoption curve, and I believe that that's going to be the solution.
I think there's huge voids in technology, and I don't think it's in like theoretical technology. I don't think it's like people need to publish more papers on archive. I think it's the adoption of technology within financial institutions. It's the fact that when you look at things like Basel and how long that took to roll out, purely because it was very difficult to write a very long SQL query. That's the difficulty that financial institutions have, is tying all of the different trading books together and figuring out how they're going to move that onto a blockchain. It's a vastly complicated infrastructure query. It's going to cost them hundreds of millions of dollars on each entity. And so I think one of the key unlocks there is, from a technology perspective, is consultants that can figure out how to migrate SQL databases. You know, that's the basic thing.
Yeah. And how do we ensure that privacy tools are built in a way that's fully compliant?
I think one of the things with compliance is we look at it as effectively like a shadow ledger. So when you have one of the biggest breakthroughs in blockchain was that you centralize the ledger between two counterparties, therefore you didn't need to tie out at the end of day. Compliance, you still need to tie out pre and post transaction between two entities. And so what no one has really managed to crack at the moment with the compliance side is the centralization of a shared ledger for compliance. And that's why we still struggle to get the unlock of kind of the DeFi Lego, as it were, in traditional finance moving into the blockchain. One way in which people can potentially do that, the Circle guys came up with a really interesting idea, which I think is going to be messed up by compute costs and gas chain costs of gas on chain. Which is the idea of clawbacks on ERC20s. But you can do that in TradFi, but it would be wildly complicated to execute.
I think one of the things we built is something which is based on the jurisdiction of an asset class. The rule sets for issuing securities are embedded on a token level. So the governance is already embedded on the token level and the compliance as well. So just to give you a little bit of a brief about when your securitization works, when you tokenize real-world assets on blockchain, you have to actually compile with the regulations and based on the jurisdiction where you're issuing the asset class, where the assets on the chain. So we actually embed on those compliance on the token level, which actually kind of gives more flexibility for the institutions to issue assets on blockchain.
Okay, and how close are we to enabling trading, private trading of real-world assets on chain?
Yeah, I mean, sorry, so the KYC, KYB, KYT, or AML, it's already compiled on the on the token level, so asset level. Think about it like that. So once you actually tokenize the assets, and the token holder is actually the investor is going to be buying those tokens, the KYC, KYB, KYT is already kind of compiled on the token level. So that actually increases more of the regulators' belief that the KYC or KYB has already been done. I think that's something which we've been seeing a lot of progress on that front in terms of the investors buying those digital assets token class.
I would say one of the most difficult bits in there, to just jump in on that, is when you do tokenize RWA, what's the point of it? So you get the transferability, which is one thing, but I think what a lot of people want to do is DeFi-style operations, collateralization being one of the main things. That's where liquidations, that's the most difficult bit of the compliance component.
Yeah, I mean, sorry, I just want to add one point thing. See, the biggest issue in RWA since beginning, because we've been seeing this space since 2017, is the regulation, compliance, and liquidity. There are no distribution rails for RWAs. I mean, you can issue as many as tokens, but those tokens are only sitting on the chain. Who is actually buying them on a buy side? That's one of the reasons that we see that we've actually introduced something called as a connector, which connects the multiple buy-side networks, like family offices, pension funds, endowment funds, sovereign funds could actually now invest in those digital assets through the regulated rails.
Yeah, and I think the other element where we struggle a little is the interoperability as well. When you're talking RWAs, where they're issued, how they're issued, and the ability, when you say about liquidity, where does that actually sit if you want to go across multiple chains? And I do think that there is problems to be solved there, but it is moving forward.
Yeah, on that, actually, there was a big issue with, this is one of the big issues we've seen recently, is like Pendle, for example. So on some of the Ethereum chains, there are these kind of swap platforms. And what we've seen is that people will take their RWAs and they will kind of like, the fixed income universe is starting to grow a little bit. They'll use Pendle, et cetera, et cetera. There's no liquidity on the other chains. So people start bridging them over to the other chains. How are you supposed to liquidate those things in DeFi? And then suddenly you get everyone saying, oh, this is fine because you can bridge it. But fundamentally, there's bridge risk, there's time delays. And then you end up with all of these problems get like, massively propagated. And then when you have an issue like the other day with some of these funds blowing up, suddenly everyone realizes the time delays actually matter, the liquidations don't happen, and suddenly everybody gets held with nothing, tokens worth nothing.
Okay, and how can we build systems where regulators can verify the activity without having full visibility?
Regulators are always going to have as much visibility as they need as they build out within this space. I think we're learning, and as we go, regulation isn't always 100% there day one. MiCA has brought in some great frameworks. The US is bringing in their framework, although we're yet to see exactly what that's going to be. I do think, again, it comes down to the element of everything is auditable, but what do you need to disclose? For example, if you look at an equity trade right now under MiFID II, there are certain disclosures you have to do within a certain time frame. It doesn't mean to say that you're making every single element of that transaction available to everyone. And again, this is where it comes down to that selective disclosure. Sort of things that you can do on Midnight will allow them to disclose the right information to the regulators. Whether they'll get that right day one in terms of exactly what they need, that will grow, and that will allow the banks and the institutions to build out more products.
I think the regulators doesn't require the entire visibility, I believe, right? I mean, based on the use cases, like if you're using, we are working on, issuing municipal bonds for one of the state, county in US, and we've seen the regulations for the regulator is actually required only for the purposes of, who is actually buying them and what's the source of that income. And that's something which you can actually build something now with Midnight feature where we can actually have that programmable, kind of, selected disclosures to be, given to the regulators. I think that's something which could probably speed up the entire, regulators' adoptions as well.
Okay, and what's the biggest risk that institutions see in private finance on public chains?
Tornado cash. That's it. They're just worried about that. They're worried about reputational risk. You have dark pools all the time. The fundamental risk is that you get pinged by regulators saying that DPRK has suddenly washed a load of funds through your entity, and you didn't know about it, and then you're done for. That's basically what they're worried about.
Yeah, I think it's on the risk side. It takes a lot at a large bank to go into a new asset class, a volatile asset class, as we're seeing right now as well. It doesn't just take one or two people. It takes a lot of different divisions within a bank to put forward the ability to move into it. And so when you talk about the reputational risk, it's not just of the whole organization. It is going to be the sponsors internally. It's going to be the person in risk that signed it off, the person in compliance that signed it off. And then if something does go wrong, who's the one who's accountable for it? So I think the biggest risk is the ability to move forward in a way that they see compliant internally and get it signed off.
Well, this is the thing, Danny, like, why would you bother as an individual? Why would you put your career on the line when you're making enough money in fixed income and equities and FX? Like, what's the point? So you've got to have like a damn good reason to put your reputation on the line and sign that off. You've either got to be a massive evangelist. I can't even say that word, but whatever, you know what I mean? You've got to be really keen on the tech just for tech's sake. But when it comes down to it, your kids' school fees are not going to get paid if you cock this up. And so why would anybody put that on the line, you know?
Yeah, I think they both have covered almost everything. So.
Okay. And what's the hardest part of making privacy work inside a regulated environment?
I have no idea what you just said.
You do what?
What's the hardest part of making privacy work inside of a regulated environment?
Well, I think, again, if you look at any institution, as soon as you start to say that you want to use privacy, it looks like you're trying to hide something. That's not necessarily the case, what we're saying here. What we're saying here is, what do you need to disclose? What do you want to disclose? So I think that the word in itself, in terms of trying to create privacy within regulated environments, is the problem. But that's not what you're actually trying to do. What you're trying to do is provide the right information to the right people that you want to disclose to.
From regulators' perspective, privacy is not a secrecy. Actually, it's much more of a transparency in terms of accountability is concerned from the regulator's perspective is concerned. So I believe the more such kind of programmable privacy we could actually demonstrate to the regulators, I think that would kind of give them more comfort.
I think the regulators are a representation of their member body. And if you look at, all you have to do is scroll through the FT comment section and you realize what the member body's view of privacy is. It's like, why do you want to do privacy? Because you must be doing something illegal. That's basically what all the comment section on the FT says every day. And until that changes, it's going to be difficult.
Sure. And how do we prevent privacy from creating fragmentation across different chains and ecosystems?
Well, I think, as Midnight have already said, they are looking to bring in the chains into it. So I don't think it's going to create fragmentation. In my opinion, it's allowing you to use someone like Midnight with however you're trying to transact.
We work with almost most of the chains, from EVM to non-EVM. And our experience, we are extremely excited about Midnight because of the, of course, the programmable privacy. But then we, now since we've actually positioning this together in front of the institutions, I think that would actually get us, really big, demand from institutions to just be jumping on, this whole privacy feature.
I don't think they'll get fragmentation so much. I think as every time a new chain comes up, or side chain or anything, it very much depends on the sponsors and the relationships that that chain has. And I think what Midnight has done a really good job of is reaching out to a lot of different sponsors. You see Zcash, you see Near, you see all of these other big teams that are all involved in the Midnight vision. And I think that's why they'll probably not suffer the issues that other chains have had with liquidity and fragmentation.
Okay, and what guardrails need to be put in place to ensure that everything is sort of kept, people are protected, investors are protected within private systems on blockchains?
Can you define what you mean by protected? Protected against what specifically? Like fraud or criminal activity?
It could be all sorts of different.
So from the investor's perspective, in terms of investing in those assets which they are putting it on chain?
Maybe making sure that you're not accidentally trading with people in sanctioned countries, or
I think that's what we talked about, right? That's the pre and post trade approvals, and I think that's not, given the tech exists, like MPC TLS, ZK TLS helps you do these kind of things like really quickly. And so long as you have the ability to just flash someone in terms of like check their existing exchange account or check their existing bank account, you can do that in seconds. That's not a bad UX, and people won't be bothered, I think.
So when you so just to give you an example about when we offer real-world asset tokenization as a service. So think about it that all the regulations for that particular jurisdictions and those rule sets are already defined on a smart contract. So if somebody is buying from the U.S. securities, which is issued under Reg S, is an exemption of SEC. So you cannot buy something from those countries which you are banned or are not kind of qualified enough to actually buy those. So you can set all of these in those smart contracts. That's what we call it as a jurisdiction set of regulations.
Okay, and at what point is private trading of RWAs and others, tokenized equities and things, at what point will this become truly mainstream? Is it going to be next year, 5 years? Like, what's the time frame?
I think it's happening now. I think you look at the. I think the big driver of this is going to be collateralization in DeFi. It's the fixed income universe. It's the thirst for yield. When you look at institutions, and I don't like the word institutions at all, actually, or TradFi, what I like to think about is real money and hedge funds. At the moment in crypto, we largely only have hedge funds, and both sides of the trade, which causes a big problem in terms of like when people are looking at TVL, because they're getting from one hedge fund and selling to another hedge fund. It's very predatory. Whereas what people are looking at moving into is offering fixed income products, and it's the fixed income products that require some kind of like yield generating asset underneath. And you don't get many yield generating assets in crypto other than staking, and therefore there's a need for things like credit and, well, basically credit is the main one, right? Coming on chain. I think we're a world away from like pension funds and kind of fixed term liabilities, but I think it's credit which is kind of the growing thing in this year and next.
I think money market funds, private credits are getting really good traction from the RWS perspective on chain. And yeah, we've been seeing since 2018 there was people were talking about RWS, but now it's going to really happening because I see the Genius Act, it's going to get passed. Most of the financial institutions, like think about it like a Bank of America relationship manager would come to you and say, I can actually open your digital wallet because they want to keep their stable coins. So that would increase more adoption from the retail end. And once you have a wallet, you can buy digital assets, any digital assets, what you want. And that's going to be, and that's one of the reasons that we see that the time is now.
And I also think the efficiencies that blockchain brings to the banking system, again, having worked in large banks and seeing the number of reconciliation break issues, billions and billions of dollars that just are unreconciled on a daily basis, and bringing in blockchain and an RWA that's tokenized solves a lot of that for them. So I think it's the efficiency that drives it. The retail will definitely be driving it as well.
Yeah, middle office end of day checks are nightmare. So that's like, I 100% agree.
Yeah.
Okay, and then quickly, what big unlocks are we going to see next year? Like, what changes can we anticipate?
What chain?
What changes can we anticipate for sort of private trading on?
I think fixed income. Fixed income is going mental on chain already. You've got the if you look at the history of like how TradFi evolved, I think at the moment we're probably in about the 1970s where Eurodollar market has just started exploding. You can see that with dollars and stable coins. The next thing that happened in the TradFi market was then you started with swap markets starting to evolve. And the first thing that actually happened in TradFi was treasury stripping. And that's what happens. This is why I brought Pendle up before, because it's so relevant in terms of the timeline of TradFi. The first thing that happened in TradFi was treasury stripping. And then the next thing, the swap market. And then after the swap market, you had a growth of fixed income for the next like 10, 20 years, and it became the biggest asset class. So I think that's what's going to happen over the next 2 years. I think that's going to be huge.
I see private equity, money market funds, or something which is definitely going to more come on chain.
And for me, it would be the banks starting to do real custody of crypto assets. I think that unlock has been demanded for quite some time, especially in the US now with the tier 1 banks. They're moving forward, the regulations come in, and it will bring more activity and knowledge base into this area.
Amazing, awesome. Well, thank you for all of your insights. If we can get a round of applause for the panelists.
Thank you.
Thanks so much.